Hello, everybody, and welcome to the Dorsey Wright podcast for Wednesday, September the 30th, 2020. I'm Jay Gragnani, and here joining me this week is Steve Raymond. And Steve, great to be talking to you today. Hard to believe, as I was looking at the date, September 30th is the last trading day of September, the last trading day of the third quarter. And hard to believe it's already the end of September, and October is going to kick off tomorrow.
Yeah. In fact, JG, I would say that the days are slipping away pretty quickly. I'm not sure that's only COVID or could it be age, but things are moving over the summer. And as you know, we're always interested in that last quarter of the year. And of course, we did have a seasonal bump here, down and back up, and we're still in the middle of some volatility in the seasonally weak September. As adages go, October can have some volatility as well, but sometimes that October volatility ends up better than sometimes than September. But yeah, things are moving along pretty quickly, and I guess that's the new era that we're in. It gives us something to maybe talk about today of things that are important to the advisor. To consider, as we move into a very important last quarter of a very important year. Back to you, buddy.
Yeah, that's right. I mean, you're looking right now in the S&P as we started off the month of September, the markets hit new all-time highs within the first couple of days, then saw nearly a 10% pullback at least on the S&P 500. And, as it stands right now, the S&P 500 is down just a little over 4% on the month. And, it is trying mightily, as it has been over the past, really week to get back into positive territory for the month of September, although it looks like it's going to fall just short of that. Nonetheless, as you mentioned, September is one of those months that tends to be weak for the markets. October, certainly there's a fair amount of high profile events that have happened over the years in the month in October's in years past. And then we're obviously in a U.S. election, presidential election year. So, certainly wouldn't be surprised to see some more volatility, and these seasonal biases, are things that are very real in the markets, and things that we have to navigate through, day in and day out, year in and year out. One of the things though that we have found over the years that has helped in trying to navigate some of these markets is just utilizing and leveraging relative strength to help identify some of those leadership trends in the market. And so today we wanted to talk a little bit about relative strength, what it means, how we view relative strength, and maybe a little bit about where the relative strength picture looks today. And so, when I think about relative strength, I think about it as a means of identifying leadership in the marketplace. And it's a means of, comparing one thing to another. And relative strength, conceptually, is something, that we're all inherently familiar with. It's something that we all inherently understand, in the sense of other aspects of our lives, and something that we don't necessarily think about a lot when it comes to investing. And if we think about it from another perspective, and you think about, I think sports, Steve, I know sports are certainly near and dear to my heart. I know it's near and dear to your heart as well, being an athlete over the years. But it's something that I think we can all inherently understand, whether you play sports or whether you don't. You inherently understand sports rankings. And sports rankings are nothing more than, relative strength ranking within their respective sport. And if you think about golf for a second, golf, is a sport that they have rankings. If you go up, you can look at, the world golf rankings, and you can see which athletes, which golfers are ranked the strongest and which ones are not. And if I were to have you put together a portfolio of golfers, I say, which golfers do you want to select for your portfolio, these are going to be your golf investments, and they're, the ones that win, they're going to pay off more. And, if you go and look at the world golf rankings right now, you see, Dustin Johnson has the #1 rank. John Rahm is #2, Justin Thomas, Rory McIlroy, Bryson DeChambeau. Those are the golfers. Those are the top 5 golfers in the world based on their world golf rankings. If I said you can pick any 5 golfers you want to have on your team right now, which golfers do you think you would select? Would it be those 5 that I just mentioned, that the top 5 golfers in the world, or would it be golfers down towards the bottom, such as Brendan Steele, with the 99th golfer in the world, and maybe Harry Higgs, which is the 97th golfer in the world? Chances are you're likely to select those golfers that are in the top 5, right? Those are the golfers that have actually won and displayed the ability to win golf matches and golf tournaments over time. It's not the ones that are down at the bottom that have the most quote unquote upside potential because they haven't been able to win yet. It's those that have displayed the ability to outperform and to win on tour. And so, when we think about that, it makes inherent sense in sports, whether it's golf, whether it's football, whether it's baseball, whether it's basketball. It makes inherent sense in sports. But for some reason, sometimes there's a mental roadblock when it comes to investing to say, geez, that stock or that sector has rallied quite a bit, or it's moved quite a bit. It can't continue to go. But more often than not, what we find is that relative strength or momentum, inherently, those things that do better are the things that are likely to continue to do better time in and time out. And so, when we think conceptually, Steve, about relative strength, that's kind of how I think about relative strength. I know that's how we talked about relative strength over the years, but it is one of those phenomenons in investing that is sometimes very, very difficult from an investor psychology standpoint to wrap your arms around. But inherently, it's something that we're all very, very familiar with in concept.
Yeah, very good point, JG. And in fact, in those details you mentioned, there also was a subtle suggestion of consistency. For example, to win a tour, or to get on the football field, as my dad used to say, like Jack Lambert did. It's not just how good you are that day, but is there a durability to keep coming back and keep participating? And I think that the analogy you drew is very important in that, to get on tour and to win a tour, there's a lot more than just swinging a golf club, let's say. There's a lot of consistency and proven ability, to show up every day, to show up on the right days and do well. And I think that, that's kind of what we're talking about is, I remember in 1999, there were a lot of mutual funds that seemed to do unusually well for a brief period of time, and then they went away and you don't hear about them anymore. And I think that, that's kind of not what we necessarily want to focus on. We kind of want to focus on consistently, where are the leaders? As you say, they're highly likely to continue that trend of leadership and winning down the road. Of course, for those aficionados of how the market works, that's exactly what goes in. In other words, to get a stock into an index like the S&P 500, it has to gain a fair amount of popularity, even to get considered to go that far. And then when it's in the indices and it is a popular stock, it promotes a lot of new buying. Typically, stocks that get into the bigger indices are well run, well governed companies, and all this consistency is kind of built into. Hey, you got to be at that level of endurance and governance and consistency just to get in the game. And once you got into the game at that level, really those trends could continue for a very long time, longer than one, let's say, an investor or the advisor's investor, would think. And I think that's what, kind of the essence of what you're mentioning, JD, that importance of identifying leadership, and also the willingness to say, now that we've identified leadership, we're more than willing to stick with that leadership as long as that, they're in that top echelon. It doesn't have to be number one, but in that top echelon, is probably going to bring forth the big wins. And of course, if we practice this this idea of gathering the leaders and sticking with leadership, that produces enormous long-term results. Yeah.
Yeah, that's right. I mean, it's it kind of takes you back for a minute when you again think about the idea and the concepts of Sir Isaac Newton's first law of motion, and it kind of takes you back to that idea and back to school, where the first law of motion is an object at rest stays at rest, and an object in motion stays in motion with the same speed and in the same direction unless acted upon by an unbalanced force. And that's kind of the idea is, stocks that have done well, have, shown the ability over time to continue to do well. And there's a lot of academic research around this idea of relative strength and momentum. And, even something very, very simple as, buying the stocks, buying the sectors that have done the best over the past 12 months, say, just as an example, those historically are the things that continue to do better, over the next 12 months, as an example. We've got a number of white papers that we've published out there that look at, point and figure relative strength specifically, and the way that we calculate relative strength, and as well as other rating systems. Not just point and figure basis, but on our technical attribute readings. And so, for stocks, within our website, within our database, we give stocks a rating based on relative strength predominantly, as well as a little bit of trend. And so, there's a lot of importance placed on relative strength among those ratings. About 2/3 of the scores come from relative strength readings from both overall market relative strength. How is a stock doing relative to the market? So just like the S&P 500 equal weighted index, but also how is the stock doing versus its sector, and versus an equal weighted basket of its peers. Those are very, very big components. And then, there's an absolute metric in there of trend. But what we have found over time is that those stocks that have higher technical attribute ratings, in other words, those stocks with the best and highest relative strength, those are the stocks that tend to outperform over time, in buying the stocks that are, rated specifically 3, 4, and 5, which are the stronger names, versus those stocks that are rated 0, 1s, and 2s. And so, that is a great way, a very simple way to evaluate stocks. Very simply, based on those scores, if you're screening stocks based on fundamental criteria, you can utilize relative strength or technical attributes to help identify which of those fundamentally sound companies are also technically sound from a relative strength and technical analysis perspective. And Steve, we do the same thing. I mentioned technical attributes specifically, but conceptually, we have the ability to do a similar type of analysis on ETFs and mutual funds through what we call a fund score, which is, instead of 0 to 5, it's 0 to 6. But, conceptually, it's split out very similarly, where there's, about 1/3 of the score goes into trend, but then there's about 2/3 of that score that is looking at a number of different relative strength measures. And so, relative strength is certainly something that is very, very important in terms of what we do, in terms of how we identify and we evaluate the markets, whether it's individual stocks, whether it's ETFs, or whether it's mutual funds.
Yes, JG, and the good point to make is that we do monitor the trend part of the relative strength, because as some people suggest, maybe don't always suggest all the time, is that past leadership should move forward to be future leadership, but things do change, and so you do need that trending component to separate the rating system from just simply aligning up all assets and how well they did last year, let's say. So what you find with let's say a fund score system, it does much better than just knowing who won last year, because it's paying attention to those trend lines that can change and do change. And I think that this would be a good spot to mention, the counter argument, which is as leaders tend to trend in a leadership mode, both referring to trend and relative strength, laggards tend to move in a negative mode, in a negative trend, and underperform for long periods of time as well. And see, and that's the opportunity disparity that you have to think about, because you could say, well, I've got some low priced things that are out of favor today. I think that will be the right choice for my client, maybe from a value or a contrarian point of view. But keep in mind that those negative trends can last much longer than you think they might. And while you're enjoying a negative trend and underperforming, as it happens, then you're actually losing out on even what the market in the index may enjoy, and certainly what the relative leadership might enjoy. So really understanding the trends and the relative leadership, or you could say also the negative trends and the negative leadership, meaning the laggards, is very important, because that's really going to impact your selection criteria. Like you could say, well, I'm going to participate in this asset class. I think the asset class is okay or good, but that still doesn't answer the question of those members within the asset class have a leadership curve and a laggard curve. And I think it's important to remember that, you have to follow those trends within the asset class to avoid that laggard effect, which could really last years as well. So that's a good point, JG, is that, the trends work both ways. So we want to be in leadership because we don't want to be with the laggards, is another way to say that.
Yeah, absolutely. I mean, and you mentioned, where within the asset class. I mean, U.S. equities have been, a very dominant asset class, really over the past decade. You go back to, obviously coming out of the 08-09 global financial crisis, and over the past decade, for the decade of the 2010s were a very, very strong decade for U.S. equities, and that was very persistent, was very consistent in terms of U.S. equity dominant. But that was not the case for every asset class globally. International equities over the past decade, it was almost similar over the past decade, the decade of the 2010s, where international equities kind of had a lost decade, very similar in scope to what we saw out of U.S. equities in the early 2000s. So 2000 to 2000, to the end of 2009, the S&P 500 was basically ended the decade at the same level that it started. So that was dubbed the lost decade for U.S. equities. Now, there was a ton of opportunity underneath the surface of U.S. equities. Small caps had, a very dominant run in that decade. And so, to your point, these things can certainly last in terms of things being out of favor, but also areas of opportunity. They can last for quite a while, because that decade was also, while U.S. small cap did well, international equities, emerging markets did phenomenally well in the early 2000s, and that dynamic, that profile, that anomaly or phenomenon kind of turned itself on its head over the course of the past decade. And so, that's one reason why it's important to continue to monitor these trends, monitor the relative strength ratings. But even within equities, I mean, U.S. equities over the past number of years, you mentioned kind of the dynamic of value stocks underperforming, and there's been many years over the the recent history where there's been a call for value to come back in favor, and it just it frankly hasn't. You go back even over the past 4 years, and large cap growth has been the number one ranked style box. And if you look back going to 2014, so over the course of the past 6 years, 5 out of the past 6 years, large cap growth has been the number one performing style box out of the 9 traditional style boxes, with small cap growth and large cap growth and large value and the likes, all of those. The 1 year that didn't happen, so from 2014, large cap growth, and even 2013, small cap growth was the best. So still growth, but say 14. So basically the past 6 years, large cap growth what has been the best performing style box. The one year that wasn't the case was 2016. 2016, you actually had small cap value see a nice rebound in the midst of a lot of volatility, but still that large cap growth space has just consistently, continually dominated, and has done so for probably much longer than many people would have thought.
Which is how this works. The length of time exceeds, in some cases, the average rationale of the investment advisor or the investor themselves, where it just, some trends can last a long time. And I think that's a very important point, that, you continue to have to monitor the situation. The non-U.S. performances in the first decade of the millennia were outstanding, but it did change. And that's a key point to make. So you couldn't, and JG, as you recall, no names mentioned, but we actually know many, we know some investors that stuck with the non-U.S. theme deep into this decade. And we know firms that did the same thing. And the idea is that, prognosticating that something should continue when it actually did change, can be harmful to the allocation performances. So the idea is that we don't know how long a trend can last, but we're not going to bet against a trend that's in force. So if there is a laggard, we continue to see the laggard metric, then to us it's a laggard. If there's a leader and it continues to hold the leader metric, then it's a leader. So it's really a simple evaluation process, if you will, and we stick with those trends without discounting how long they should last or how long they will last. I remember back in the early days, some would tell me that, once small value gets running, it usually runs for 7 years at a shot, which is an interesting adage, an interesting comment. But as you just mentioned, Jay, in 2016, it popped its head up quite well and didn't last the 7 years. It faded away pretty quickly. And so, I think you'd be careful, of any adage that tends to suggest it knows how long something will be in effect, and really go with, that trending dynamic and that current relative strength dynamic to ratify or recertify. Yes, we're following the leaders, and if that changes, we'll change. And I think that's an important concept. In addition to that broader concept, there's like within a group that we like, underneath the hood, there are better or worser choices underneath the hood. And I think we need to be careful with how we do the selection process, and then really stick with the same concept of going with leadership. I remember the latest kind of, over the last few years, small caps have really helped in some, no pun intended, small way. But there have been some small cap areas that have been pretty poor and have maintained, a bottom quartile type of leadership, meaning a laggard, right up to the present day now. And I think it's important to distinguish that not every fund or not every opportunity or not every stock within a certain category or class necessarily means but each asset has to go through the rigor of the attribute test, the score test, the test of relative strength and price trending, in order to certify that we're indeed on the right road. And I think that by paying attention to that increases the performances. And the other point, the allegory is true. Not paying attention to that can be very costly. I've looked at a fair amount of client accounts of the different advisors wanting to say, hey, what's going on here, and get a third opinion. And I do see some things going on in some of those accounts, and some of them have done very well by focusing on the leadership, and then here and there you see where there was a lot of missed opportunity because there was the wrong selection, a kind of very obvious laggard selection in a portfolio where again, if we're paying attention to the rankings the attributes and the scores, we're not going to be in that laggardship part of the curve. And those can end up being costly decisions. So, someone said to me once, well, if we're not sure what the market's doing or what's going on, let's just go with broad indices. Well, I'll tell you, small caps have some good, some worthwhile players underneath the hood, but the broadest small cap, like a Russell 2000 small cap, which really encapsulates, the whole, what we call the whole dirty small cap broad market, has actually been a bottom half player for years. And in some sense, to this day, a bottom quartile player against other small cap opportunities one can do. Now, I'm not picking on the Russell version of an index. That was not my point. My point is that there can be trends in certain parts of the market that continue on the laggard side, as we mentioned before, as well as trends that continue on the leadership side. And if one's not sure which one's which, you really do need to kind of subscribe to a firm like ours, to get in there and say, hey, what are the ratings that are on this exact fund that I'm interested in? Because that's an important decision that really will drive outcome, meaning your outcome, your experience with you as the investor or with you and your client as the advisor can be greatly impacted by understanding where that relative leadership is and where it isn't, and not make what I would call, a loose decision and going with just an average fund or just a fund on a piece of white paper sounds like it should work. It may not work. And I think the point of today's conversation, Jay, is it may not work for a while, and we need to avoid those. We need to avoid those decisions that lead to laggard trends that can last for a long time, because several of those decisions can put us way behind the benchmarks that possibly clients, other advisors, or anyone else might be keeping a track on to measure our performance. So again, keeping up with the leadership of asset classes is extremely important, and then keeping up with the leadership within an asset class is very important and very beneficial to stay ahead of the game. Back to you, Jeff.
Yeah, and that's a good point, Steve. I mean, certainly, things can. What's the old saying? The markets can remain irrational much longer than you can remain solvent. And I think that is certainly very, very true in on both sides of it, in terms of continuation of trends. Not only positive trends, but negative trends can last much longer than sometimes we may realize. With that said, relative strength is an investment philosophy and methodology that, while over time there's been a lot of evidence to suggest that it works well over time in terms of studies, in terms of performance of stuff, but it doesn't necessarily mean it works every time. And there certainly can be years, and we kind of alluded to a little bit that 2016 was one of those years where relative strength, where we saw a laggard rally, moving away from growth and more a value tilt towards that year. And those things can happen. And so 2016, you talk about, when does relative strength not work, or when is it, what type of market environments and market conditions does relative strength struggle in? And a market environment like a 2016, where you get a lot of volatility, you get a lot of choppiness, and there just really is no trend. It's very much a trendless market in 2016. If you remember the year and you go back and you kind of look at it and you study it, there was a lot of volatility, right out of the gates of 2016. January, February, the market corrected almost 20%, but you had this kind of back and forth action, very, very choppy over the course of the year. 2016 also was, like this year, is the U.S. presidential election year. So, there was certainly a lot of volatility leading up to and following, the election that year as well. And in addition to other geopolitical things going on, the things aren't necessarily the the important part of it is, but those types of market environments, 2011 market environment, again, you had a lot of choppiness, a lot of volatility. And so those are types of years where you tend to see things underperform from a relative strength perspective, where you might get some laggard rallies. You also, when you think about in market environments that are more conducive to a relative strength investment strategy, the larger, the wider the dispersion of returns within a particular area are, is going to be more conducive to a relative strength strategy. And what I mean by that is, if you just, we'll use U.S. sectors just as an example. Think about the big macro sectors, so technology and energy and utilities and healthcare. So kind of the 11 macroeconomic sectors that are out there now. In years in which the dispersion of returns amongst those sectors is wider, meaning, the difference between, say, the best and the worst performing sector is big, those are going to be years in which a relative strength, a sector rotation type of investment strategy are going to tend to do much better, because there's a lot more opportunity to seek excess return amongst the leadership areas. Years in which that dispersion is narrower and the returns amongst all the sectors are closer together, those are going to be years in which it is a bit more difficult to find the leadership trends and ride those trends. And so, that's just, if you're beginning to embark on employing and implementing relative strength into your strategy, there's a lot of evidence, out there, and a lot of research that has been done, that we've done, that third parties have done. There's academic research that talk about relative strength and momentum as an investment factor that has shown the ability or the potential to outperform over time. But in terms of when does it not, those are the types of market environments where relative strength is going to tend to underperform. And to put kind of some numbers on that, just as an example, so far this year, and we're almost exactly three quarters of the way done with this year. And the difference or the dispersion between the best and the worst performing sector this year is about 76%. That is technology being the best at up 26% this year, energy being the worst at down 50%. So the dispersion between those numbers is about 76%. Last year, the dispersion in 2019, was about 52%, so still pretty big. In 2016, that number was 29%. And so, less than half of what we've seen so far this year. So just to kind of put that into perspective, we've seen a rather large dispersion in performance amongst sectors so far this year. 2020 so far has been, a year. 2019 was a year in which relative strength tended to do better. If you look at some of the momentum, the relative strength, the sector rotation strategies that are out there in terms of seeking excess return this year, those have been good, and they've been able to capture the trend, the general trends of growth dominance, technology from a sector perspective being a big part of that growth theme. And so that's just something, when I think about relative strength, and I'm always thinking about, okay, when is something not going to work? Maybe I should be thinking about when is it going to work? But I'm always thinking about, okay, what type of environments does something tend to underperform a little bit, and so those are the types of environments, and I think that's important to just kind of understand and be cognizant of and be aware of.
Yeah, JG, that's a good point. And an addendum on top of that would be, the helpfulness of new trends and new relative strength in areas that no one had prognosticated would occur. I'll give you an example on that. As we came into 1999, in some sense ending the 90s, it was pretty clear that everyone was very sure what works and what doesn't. And in that case, a growth dynamic, and a large cap, a mid cap, small cap growth dynamic. And by the year 2001, the whole game had changed as far as new trends come, into the horizon, new relative strength signals that people hadn't seen. I would say in some cases in their career, and new opportunities unfolded that really were not prognosticated by academics or by firms or any other leaderships that one might look to say, hey, where's the ball moving to? And I think that the importance of having the relative strength is not just to say, well, there'll be times where it slows down a little bit, but the incredibly important guide it is into moving into new market landscapes where there might be huge opportunities in various asset classes that, let's say, we as advisors, you as advisors, or you as investors had not been doing for a while. And you need that confidence. If there is a change, what is the change to? Where's that new opportunity? Because, what we've been doing, let's say, you're saying to yourself, what we've been doing for years and years, well, things just changed. So being able to have confidence to say, hey, I work with a system and I know that when it changes, it's important, and move to those new opportunities, and then go from there. And I think that's also a very important point, because it'd be easy to say, well, all we need to do is find the leaderships today, and that's probably the way it's going to be all decade. Well, that's actually not how this works. As JG mentioned, there are decades of trends, but we don't know when some start and when some finish. And I think that that's very important to say. Is you need the tools, you need the strategy, you need the metrics in order to stay current with what down the road. In hindsight, you'll say, "Oh yeah, that was obvious to everyone." No, it wasn't. I'll point out a couple more layers on that era that I mentioned a moment ago. Is that I don't remember any firms that had any overweighting in the first decade of the 2000s on non-US, for example. Even after a year or two of the non-US doing extremely well, where attribute and relative strength and trending metrics picked up on it fantastically. So the idea of being ahead of the curve is trying not to be behind the curve. There was no one in 2001 saying we're about to enter into the most beautiful small value and non-US market that anyone's ever seen. No one called that out ahead of time. In fact, what you find and what you found is leadership amongst the firms and leadership amongst the academics were in some sense unaware or unable to to point these things out well into that run, well into it. And I think that what you want to do as the craftsman, as the advisor, and of course as a craftsman investor, is realize that if things change, when they change, that you have the confidence to make that change also. And that really gets you in on an earlier part of the maturation of the new relative strength trend that could then last for quite a while. So I think that the tool has benefits. The concept of relative strength has benefits on many tangents. One, to stay in leadership. One, to have great performance. One, to stick with your game plan. One, to have excellent selection mechanics. And then, as I mentioned, this ability to change when things really do change, which is, sometimes I would think very difficult to do if you didn't have a system, because it's very difficult to change one's mind if they've been doing the same thing for 5 years. It's hard to change into a new way of thinking, and so you really do need the mechanics, the system, the culture, the metrics to say, hey, we've got something new. Let's get on top of it right now. And I think that's a very important point of relative leadership, because you might not need all the metrics, and you might not need, in some sense, to join the culture or just to subscribe to a discipline. You don't need that if it turns out to be true, and we already know that technology might be the biggest sector, let's say for the next 20 years, well, then maybe you don't need to stay on top of the game. But I would put forth that really historically no one ever knew what was going to happen in the future, and I think that can be demonstrated over and over again. The future seems to make a lot more sense once we're past it and we're looking backward. That seems to be something that everyone can relate to. But just to think that how the 20s as a decade will be and how they'll end up, I don't see any evidence that one would be able to prognosticate that. And in fact, things may go very differently than one had prognosticated that. And again, what that does is it reinforces this concept of, well, I need a tool set. I need a discipline. I need a method. Because what Steve said is probably true, where I need to be able to adapt to markets that maybe I didn't forecast, even if I'm forecasting, that I didn't forecast could happen. So the idea is that tool set is what differentiates the advisor and the investor and their experience. And certainly, as I just pointed out, let's say for the next 8 to 10 years. What is the experience that we're going to have? Well, it's going to go one way if we have no discipline or no metrics or no subscribe to no discipline, but it's going to go quite a good way if we're involved in the discipline and we're using the tools and we're working with the concept of relative leadership, relative strength versus relative laggardship and relative weakness. And I think that that's what you have to decide. And today's a good day to decide that, because hey, we're just come a day or two, we're moving into the last quarter of a very important year, and I'm sure that if we make decisions in the last quarter, they need to be the right decisions. Certainly, hopefully, one decision we might make is there are no changes. That's one decision, but another decision could be, hey, there are some changes. Let's take advantage of those changes. And let's get in line with the harmony of the market. So JG, I think you're right. This whole concept that we spoke about today is extremely vital on many levels, and can benefit the advisor and the investor in a lot of different segments of their decision-making process. Back to you.
Yeah, that's right. I mean. And the one, Steve, you and I could probably sit here and talk about this for the next few hours. One thing that I would ask is on the heels of your last comment, I think I heard you say you were right. If you could call my wife and remind her of that, and my kids, that would be much appreciated. But in all seriousness, when you think about relative strength, I think one of the big takeaways is that relative strength is a means of identifying leadership. It's a means of being adaptive to the markets and the ability, the willingness to be adaptive to move to where the ball is going, to move to where the puck is going, is certainly something that has been, that it can be tremendously beneficial to advisors, to investors over time. And I think, for me, that's a big takeaway when we think about, relative strength and just that investment methodology is, being adaptive, being willing to be adaptive to the changing market dynamics, because the next decade may look very, very different than the previous decade, which, looked very, very different than the decade before that. And so, the markets are always changing. They're always evolving, and it's, being able to have a game plan, to have a discipline, to have a system, in place to have a means of identifying those leadership changes is something that we place a lot of importance on, and a tremendous amount of investment methodology on over time. So Steve, it's always a great discussion, and always something that is important to kind of go back and think about, and especially as we're entering in the fourth quarter of the year of 2020, and a a lot. Obviously, has changed this year. Has changed within the markets. Has changed within our day-to-day lives. Within how we interact with not only colleagues at work, but neighbors and friends outside of the office. So certainly appreciate the discussion.
Yeah, thank you for the opportunity.
So with that, hope everybody is continuing to do well, and appreciate you taking time out of your day to listen to what we have to say. As always, if there's anything we can do to help you and your business out there, please do not hesitate to contact us. Our number is 804-320-8511, or you can reach us dwa@dorseyright.com. That said, appreciate you all taking the time. Look forward to talking to you next week.